Hi, folks. After COVID, the gold prices have really gone up. Even during COVID, it shot up quite a bit because people perceived it as a safe haven between all the chaos which was happening around. After that, folks thought it might stabilize, but there were a few geopolitical tensions and conflicts like the Russian Ukraine war, the Israel Hamas conflict, and a few other skirmishes. At around this time, central banks across the world started moving away from the dollar and building up gold reserves to reduce their dependency on the dollar. This was led by China largely. Usually, gold prices shoot up, then stabilize for some time and shoot up again. But in the last 2 years, we've seen a very high rise in gold prices. This has made a lot of investors curious about it and wanting to invest in it. Now, if you've already invested in gold through any one of the methods that you can invest in, you might be wondering, is there a better way to do this? Or even if you're a first time investor, you want to invest in gold, but you don't know which is the best way to do it, then this video is for you. I'm going to break down 5 methods of investing in gold and what are the advantages and disadvantages for each of these methods. So I've chosen the 5 most popular methods of investing in gold: gold ETFs, mutual funds, digital gold via apps, jewelry schemes offered by jewelers, and physical buying and possession of gold. Now let's see what these different methods of investing entail. Let's start with whom it is ideal for. So if you are a demat holder and you want to purchase gold ETFs as a one-time purchase, across time, you can do it many times, but you're looking to purchase one time, then the gold ETFs are suitable for you. Here, a company like HDFC buys gold, stores it, and when we give them a certain amount to invest in, they give us units for that amount that we have given them. If you don't have a demat account, or if you want to invest through the SIP method, then the mutual fund route is suitable for you. There, just like you purchase mutual funds via SIP or lump sum, you can purchase into gold funds the same way. What the gold fund does is that they further buy into the gold ETF. So these are known as fund of funds. Digital gold can be bought through apps like Google Pay, Phone Pay. These are suitable for micro investors because they have certain limits. For example, an app may say that you can put only 5,000 daily, or you can do a monthly amount of 50,000, or you can buy a lump sum of 2 lakhs. The jewelry schemes are suitable for folks who want to buy physical gold or jewelry items in the near future. So they start planning in advance. They put a monthly amount away every month, and then they may take this out in 1-2 years as the scheme's design. Lastly, physical possession. You go to a store, you can buy the item that you require. For example, you can buy gold coin or bar or any kind of jewelry items which are there. Gold ETFs buy physical gold and store it. The mutual fund route, that is a fund of fund routes, buys into the gold ETF, and the gold ETF again buys the gold and keeps it with them. In digital gold, the app provider does not buy the gold. Normally, they have a tie-up with another provider like MMTC or DigiGold who buy the gold and store it. They are the custodians. In jewelry schemes, the jeweler, of course, has vast quantities of gold and they also include this in their holding. In physical possession, we keep the gold with ourselves. We have to arrange for the storage. So how is the ease of investment in each of these methods? For gold ETFs done through a demat account, I would say that it is moderate because not many people have a demat account, and if you're not savvy in managing the demat account, it might be a bit confusing. Also, it only allows you lumps. In comparison, mutual funds provide a very easy way to buy it, especially if you're already an existing mutual fund holder. Then you can go to any of the AMCs like Axis, HDFC, SBI. Almost all of them have gold ETF fund of funds, and you can buy into that via the SIP route, even with small amounts. Again, it's very easy to buy digital gold through the apps. You can search for gold, and then you can look at the various options and buy. Make sure that you use a reliable app with a reliable provider at the back end. Jewelry schemes are confusing for new buyers who already have purchased, who have explored these schemes can understand it better. But as a new buyer into these schemes, it can be confusing. For example, one jeweler offers a scheme where you invest the same amount for 10 months, you hold it for 12 months, and you get 75% of the first month's investment as a bonus. Another jeweler has a scheme which says that invest for 11 months, take the money out, and we'll also give you 50% of the first installment and 50% of value added charges, which is making charges. So these can be confusing to understand. Physical possession is quite simple except for battling the traffic. Everywhere traffic has increased. So if you're okay to do that, then getting to the store and buying the gold is quite simple. Now let's look a little deeply into the schemes. What is the underlying asset? In gold ETFs, the custodian buys the gold and stores it. Therefore, the underlying asset is the physical gold. In mutual funds or fund of funds, the mutual fund buys into gold ETFs. So they get units of gold ETFs. So the underlying asset is the gold ETF units, which again are backed by the physical gold. In digital gold, the provider buys gold, much like the gold ETF. The provider is the custodian of the gold and they buy and store it. In jewelry schemes, the jeweler buys physical gold and keeps it with them. They may not earmark it for this scheme separately, but since they have good inventory of gold, they would part from that. In physical gold, we take possession of the gold item and keep it with us. So again, the underlying asset is physical gold in various forms. It can be jewelry or gold coins or bars. In terms of storage and security, the storage provided by the gold ETFs is very convenient because we never take possession of the physical gold. We buy the gold in electronic form, as in units equivalent to the amount that we purchase. So here the storage is handled by the custodian. We can trust them. In mutual funds, again, they themselves are not directly taking on the custody. It is through the gold ETF. In digital gold, the provider takes custody of the gold and keeps it with them. So again, it is quite secure here. In jewelry schemes, reputed jewelers would have enough security and precautions because they deal in vast quantities of gold. So this again is quite secure. The least secure in my mind would be physical possession of gold, which is kept at home. Even if you open a bank locker, then it would be safer there. But it is quite cumbersome to keep a locker, go there, maintain it regularly, renew it, etc. Liquidity is a very important aspect when it comes to any investment, and it is no different for gold. So for gold ETFs, mutual funds, and digital gold, they can be easily sold off back to the provider. The jewelry scheme has limited liquidity. You have to go back to the same jeweler and buy the gold from them. If you want to stop the scheme, you'll have to interact with their service department for stopping the scheme and taking your money out. When it comes to physical gold, I'd rate the liquidity as moderate because you have to take it to a store and you may have to comply with some of their requirements, like providing some form of documentation to sell the gold off. Now, the most interesting part, the returns of gold. How closely is it linked to gold prices? So gold ETFs closely track the gold price. They work pretty much in tandem with the gold prices. They do levy some charge for storage, management, personnel, advertising, etc. So there is some charge which is there, but still they're quite closely linked to the gold price. Mutual funds will be slightly lower in terms of returns because they also have an added expense for managing the fund which buys into the gold ETF. These are typically quite low because both forms of investment are passive. So the expense ratio is not very high, but there is an added component which you should consider. Digital gold also is closely linked to the gold prices. Jewelry schemes are run by the jeweler. So usually we can say that it will be close to gold prices, but it may vary from jeweler to jeweler. And the physical gold, again, there is a making charge which is involved. So if it is a standard item like a gold coin, the making charge would be quite low. But when it is a piece of jewelry and the more intricate the jewelry is, the more charges would be given for making it. We can't look at returns without taxation. So taxation for gold ETFs is the most favorable. If you hold it for 12 months, then you get long-term capital gains LTCG benefit, that is 12.5% on the capital gains. This is without indexation benefit. If you hold it for less than 12 months, then you will have to pay short-term capital gains as per your income slab. In comparison, for gold ETF fund of funds, that is a mutual fund route, digital gold and physical gold, we have to hold it for 24 months to get LTCG benefits. If we hold it for less than 24 months, then we are liable to pay capital gains at the income slab which is applicable. If we hold it for more than 24 months, then it is 12.5% on the gains. The taxation is not very clear for the jewelry schemes when you're holding it with them. When it gets converted to gold, that's when the taxation becomes more clear. So consult with your CA when you file for the taxation. The last item, but definitely not the least important, we must look at how gold is regulated when we purchase through these different schemes. Gold ETFs, mutual funds and digital gold are regulated by SEBI. The digital gold scheme is regulated by SEBI if it is a reliable provider like MMTC or DigiGold, Safe Gold, etc. So please be very careful when you choose a provider for digital gold. SEBI is quite concerned about investors, so we can fairly trust them to safeguard our interests. Jewelry schemes are not regulated. We are dependent on the jeweler, so it's very important to go with a trusted brand here. Physical gold is not regulated, so I would say that it depends on you or your partner how it is regulated. Whichever one has more interest in gold will manage the gold handling. So that would be the extent of regulation here. When it comes to returns from gold, where does it stand vis-a-vis a fixed deposit or an equity mutual fund? So I'd say that in the long term, gold would land between fixed deposits and between equity mutual funds. If we are expecting 5 to 7% annualized return from fixed deposits and 12 to 14% annualized returns from equity mutual funds, then we can expect gold to give about 9 to 10% annualized return in the long term. The last 2 years have seen a different kind of movement from gold. It has increased quite sharply, which is not typical behavior for gold. So if you are entering into gold investments at this time, please keep this in mind and be careful. So I hope this helps you in your investing journey with gold. If you have any queries, do drop a comment or write into us at our contact points and I'll be happy to get back to you. Thanks for watching.